Morning, everyone. Thanks for, again, weathering the storm. My goodness. I was just visiting with Rob briefly. I'm pleased to introduce him. By the way, yes, I'm Lyndall Stout, the host of Sunup. And as of Monday, it will be 11 years that I've been with OSU and Sunup. So that's the longest I've lived anywhere, the longest I've worked anywhere. But it's sure a wonderful place, OSU. And my favorite part of my job is getting out in the field, and of course this week seeing that baby wheat come up. My mom texted me after she lives in Tulsa, she watched the show Saturday, and she said, I said that on the air last Saturday when I was interviewing Brian Arnell. She said, oh, baby wheat, is that what the farmers call it? So I don't know, whatever you call it, I'm just glad to see that wheat sprouting, and the fact that we've had some rain after, for sure, some challenges with planting season. No doubt there's always challenges, but we'll take the rain. Of course, these tornadoes we don't necessarily like, but the rain is certainly welcome. Well, welcome to all of you. Welcome to campus. What an extraordinary year and a half we've all had. I do want to take a minute before we introduce our first speaker of the day to just give some kudos to my colleagues in ag economics and in the Division of Ag and at OSU for the extraordinary effort that they have put forth during the pandemic challenges to keep OSU running and keep classes going for our students, because fundamentally, as a university, that's what we're here to do. So I want to give them applause for that, because that's an incredible undertaking. All the challenges and the communication efforts, and just it's an extraordinary time, and I want to applaud them, and of course our students for the resiliency that this is building, and the fact that they're getting through this, and no doubt this will make them stronger people as they continue on in their lives and start their careers. So without further ado, let's get this baby started today. I am pleased to introduce our first keynote speaker of the day, Mr. Rob Fox, Director of CoBank's Knowledge Exchange Division. He leads market and industry research in the agricultural and infrastructure sectors affecting the rural economy. Prior to joining CoBank, Mr. Fox spent 13 years in food and agribusiness commercial banking. He has over 25 years experience in a wide array of agriculture-related roles in both private industry and the public sector. He started his career as an agricultural economist with USDA's Foreign Agricultural Service, and later became a farm business management specialist with the University of Wisconsin Extension Service. Mr. Fox and his wife, Jennifer, also owned and operated a 125-cow dairy farm in western Wisconsin. Fox earned a bachelor's degree in economics from Northwestern University and a master's degree in agricultural economics from the University of California at Davis. Please give us a warm, Stillwater welcome to Mr. Rob Fox.
Can you hear anything? This is on. I just needed to listen up to my phone. Hey, how's that? All right. Okay, great. Thanks, Brent. So, I guess I don't have to say too much about my background since Lyndall did it for me, but this is the first presentation I've given in a live audience probably in like 3 years. So it's kind of like, whoa, is this really happening? But so this is not rehearsed or anything like that. You're the first ones to see it. When I got a look at the agenda, I was kind of intimidated by the speaker lineup, because the speakers later this afternoon are often the same people that I go to get my information from. So, you know, people like Daryl Peel on the livestock side of things is one of the best livestock economists out there. So I'm not going to spend too much time on the ag side of things.
I want to, the agenda left a lot of room for more of a macroeconomic discussion. So I will put it up on sure. So I'll spend more time on the macro side. Also, the presentation, I had to turn it in last week, so it's from Thursday. So in the world of the economy, that's totally out of date already. We're here Wednesday, so a couple things will be slightly out of date. I wanted to talk of a couple of things that going on in DC to start out with. First is, you know, that last week the debt limit fight was still up in the air. So now all we have is an extension for another 6 weeks. I think that'll probably get squared away again in early December, but if it doesn't, that would be kind of a catastrophe of major proportions. But we'll just keep our fingers crossed and hope for the best. The other thing is the update on the economic packages that the Democrats have in Congress right now. There's two separate ones: infrastructure, $1 trillion. Everybody's on board with that. I'm sure this is coming in now. But the problem is the liberal side of the Democratic Party has tied it in with the other package, the anti-poverty healthcare and climate plan, which has a lot of child care, clean energy, Medicare broadening, and so forth, which a lot of those things are actually popular with the general population, but it would require an increase in the capital gains tax and the corporate tax rate. So that's why it's not happening soon, and why it's not going to be $3.5 trillion in size. At least it'll be 1.5 trillion at least, because that's what Senator Manchin said he'd be willing to go with, but it might be a little bit larger. Okay. All right, we're a little bit cut off there at the top, but everything obviously starts with COVID, and you know, me, like I'm sure you were quite disappointed earlier this summer when Delta made its resurgence. So anyway, we're back on the positive side of things. As you can see here in Oklahoma, I think people are living pretty much as if the pandemic is over. We'll see if that continues on. In Illinois, the trend rate is going down, and I was all excited, and it started to flatten off again. So obviously the political environment in Illinois is quite a bit different. Everybody's wearing masks and so on. So this just shows kind of how optimistic, excited everybody. 89% of the population of the U.S. back in June thought we were, you know, the virus was on the way out, and then boom, by August, only 17%. So you just see the massive puncturing of the balloon, the optimism balloon that happened this summer. This cut off a little bit here, but you see this is consumer spending, which is the largest and the most dynamic part of the economy. And it's been up 6%, 8% there in 2021. So that's tremendous, and it should be around 4% next year, which would be right in line with historical norms. So, you know, most economists are fairly optimistic. A little bit of tempering lately due to the ongoing supply chain woes, but you know, overall things are going pretty well from a macro standpoint. I was curious as to, you know, where the big hits to the economy happened, and you see they were recreation services. So think about movie theaters, golf courses, hotels, resorts, transportation services, that's airplanes, healthcare, and fuel and restaurants. All of those are the ones that have been hit the hardest by the pandemic. And the absolute numbers don't really matter, it's more the relative size. Can you guys see over there? And what describing what some certain parts of the economy have just done tremendously well: recreational goods, cars, grocery stores, furniture stores, and so on. So the only thing that's okay, that's awesome. The only thing that's held them back has been the supply chain problems. This chart on the left here shows arts, entertainment, food service, hotels, and just how severe the downturn was. 40 to 60% reduction in activity in those segments. And even now, we're only 70 to 80% back in those areas, and it'll be at least another year before we get back to where we were. And I have a daughter who's an aspiring professional ballerina, and it's hard that the industries like theater and art have really just been crushed. But look at consumer confidence, man. We've taken a dip from Delta, but still riding high. Consumers are pretty optimistic. Most people have cash in the bank. Savings rates are really high. Manufacturing survey index, again, near record high levels. Production is a little bit lagging behind the orders because, as you know, people can't get supplies and materials. Look at the producer prices for manufacturers of durable and non-durable goods. Prices up 50, 60% year on year. So, that's the only thing. That's the only thing slowing down the economy is people can't get the materials to make the goods, and people can't get the goods that they want. Looking at employment, this is what happened to the workforce. People employed from the pandemic, and we're still 5 million people below where we were. So the economy is doing pretty well, but still 5 million people unemployed. And it's, if you're a mathematician, which I am not, but this chart here is missing 2 months of weak. You see this curve here. If we put an estimated curve, and there's 2 months that are not on this chart that are very weak job growth right here. So if you put a curve on this, how long is that going to take to get us back to trend? This is going to take a long time, several years in my opinion. One of the reasons women left the labor force, almost 2% below where we were in terms of labor force participation rates. And, women are just like everybody else, less childcare, just fed up, too much work, not enough pay, whatever the reasons may be. That's one of the main reasons. And this is something I've been looking at for the past year or so, and I hadn't realized it. This is working age population. So this is just humans in the United States that are eligible to work. And it doesn't have anything to do with unemployment or anything like that. It's just demographics of how old people are. And since the year 2000, the growth rate of our labor force has been trending down and down. And finally, our labor force is actually shrinking, as of last year. And this is going to continue to shrink. And I haven't done the math, but it may shrink faster, because during the Great Recession, there was a big baby bust, and that generation brought to enter the labor force. So those people that would be entering the labor force won't be. So we have a lack of workers going on, and this is going to be a long-term thing, not related to the pandemic at all. Early retirements also 2 million below trend, 2 million above trend since the pandemic started. 1.9 million people who left the labor force earlier than one would expect. You know, people who are 12 to 18 months out from retirement might just say, the heck with this pandemic, or I'm not going to go find another job. I'm just going to ride it out. So another 2 million people. So you add, you know, women, retirees, displaced people from hotels, restaurants. I mean, this is a big deal, and it's going to take a long time to get this sorted out. Oops. Obviously, you've probably seen this chart, but this is, again, a month out of 8. But I think we're at 10.4 million job openings right now that are looking for workers, and only about 4 million actively looking. So there's a big gap there of excess jobs looking for qualified and willing workers. I saw this from McKinsey a week or two ago. They had a poll and they found out that 40% of workers in the United States are likely or very likely to be to quit their job or leave their job in the next 3 to 6 months. I don't know if that's totally accurate, but we just got quit numbers yesterday, and 3% of, I think it's 4.3 million people quit their job in August, which is a record high. Never happened before. So what does that tell you about job satisfaction or how tethered people are to their jobs? Society has changed in some way, some undefinable way. And in coordination with that McKinsey survey, they hypothesized that the problem is that what workers want is not the same thing as what employers think that workers want. So what workers want is to be valued by the organization, valued by the manager, and have a sense of belonging, okay? So those are the most important things, but employers, they categorize those things as less important or marginally important. So, you know, maybe employers are potentially, you know, looking at the wrong things to keep and attract employees. I'm a banker, so I'm supposed to know about interest rates, right? So here's the yield curve. It's moved slightly up in the past week or two from this chart, but you know, 10-year yields about 1.5, 1.6, and I don't see a dramatic change in that in the coming year. So if anything, slight increases, steepening a little bit in the longer term. Bond spreads, so the spread between the 10-year note, and this is investment grade corporate bonds. And you know, you see that the spread is about the same as it was pre-pandemic, and you'll see a similar situation if you look at high yield bonds as well. You know, just a little bit higher, but we're back to normal pre-pandemic on the bond side. Farm interest rates, you know, these have been squeezed and shrinking for the past 20 years, and wouldn't expect that to change much at all. You know, this is the FOMC puts out a projection every so often of what they think that interest rates are going to be, Fed levels, and these are the FOMC members of what they think it's going to be. So the end of the year, everybody thinks it's going to be 0. End of next year, if you average it out, it's probably about 0.25. The end of 2023, maybe we're getting to 0.75, and then longer term, 10 years, you know, probably around 2.5%. So really nothing if I'm running a business, this doesn't really scare me too much. Looking at trade briefly, so the trade deficit, if you look at about 2016, approximately when President Trump came on board, and there was some concern or worry about the trade wars and so on, and he was going to get tough on trade. Well, by coincidence or result, our trade deficit has nearly doubled since we got tough on trade. And really, we haven't had a free trade proponent in the White House probably since George W. Bush. So I guess I would just say, whatever we're doing is not doing a great job. And this particularly affects agriculture, because as we get more and more productive all across every segment of agriculture, we're more productive than the U.S. can consume more cotton or chicken or whatever, you name it. We have to export it. And so, to me, free trade agreements and being left out of free trade agreements internationally, that's a big deal for agriculture. Energy prices, again, this is from last month's federal report, and it's a little bit dated. But according to the government, oil prices are going to, level off. That this was about 75. We're already at about 80 now. But what I found interesting is if you plug in the options and futures data, we get a 95% confidence interval of roughly $120 to $35. So, yeah, I guess I could have probably told you that without running the numbers. It's not real confident. Nat gas prices, again, this is a little bit dated. It touched $6, I think last week. It's in the high mid fives at the moment. But again, we don't know. And this winter will be a big test. If you're not following the news, energy is a huge deal all over the world. In fact, we're doing pretty well relative, but Europe is extremely short on natural gas, and that's how they produce electricity there. And Russia is squeezing them along with various other dynamics. And China, adding to our supply chain woes, China, probably about 5-6 years ago, they started to slowly ease back on the coal energy production and coal supply. And that's just one of the reasons, but right now parts of China are like on rolling blackouts. So this is hitting manufacturing facilities in China. It's a global thing. We can export energy, and it will affect domestic prices. We're not insulated from the world. Anybody having trouble hearing me? Shipping, you see truck rates up 50-75% over the past year. These are container rates across the Pacific Ocean, 5 to 6 times. It seems to have leveled off recently, but obviously that's a big problem. I was listening to a news show a couple days ago. I didn't know this, but Los Angeles and Long Beach, where most of the containers come into the U.S., it's about a 2-week trip to get from China to the U.S. And normally about a week out, the port in LA can radio the captain and say, all right, I'm going to be pulling into berth number 32 at, exactly 0235. And within a couple of minutes, they pull right in, and normally there's 0 to 1 ship in, the harbor or at anchor waiting to get into one of these berths. Right now, there's like 65 ships at anchor Harbor, one of them caused that oil spill off of Orange County with the anchor thing. And there's another 30 that are just floating around trying to get an anchor spot. So, there's like 90 boats out there, and it's taken about 11 days at the moment to get, when a ship gets to the Los Angeles area, it's taken 11 days to get it into a berth. So, delays. 2 weeks to get it from China to LA, and then another 11 days just to get it unloaded. Inflation. This is the CPI, again, about a month or so old, but story remains the same. Is it transitory? Is it not transitory? I'm kind of in between. I think it's going to be around for another year or so. But I've never been a huge worrier about inflation. This is UCLA they have an inflation economist, well respected. So this is their guess as to this is core inflation. So it doesn't include fuel, doesn't include food, which is about 1.5 points below what that would be if it included everything. But core inflation, they're saying 4% this year, down to 2.7, and then 2.4%, which, if true, not a big deal. Here's the long-term inflation rate. This line here is 5%, which we've touched the past few months here in August, September. But the blue line is 2%. So you see, if those predictions from UCLA come true at between 2 and 3%, that's quite normal over the past 50 years. So not too unusual. Totally switching gears. I was curious as to what the pandemic did in terms of income distribution, and it looks like actually the higher earners. So this is bachelor's degree folks or higher, and this is no college education at all down here. So it looks like the higher earners did take a little bit of a bite here from the pandemic, which that actually surprised me. I thought wages for the lower income or lower education segment would have gone down, but at least not in the data. Long-term national income distribution continues kind of this very long and very slow trend of pretty much this is the top 20%, this is the next 20, so on, and this is the bottom 20. Well, when you're in the bottom 20, there's nowhere to go, right? You're already here. But that top 20% keeps on chugging away, getting bigger. Now, I'm going to totally go off the rails for an economic discussion and talk about because up till this point, nothing has really got me terrified about the economy, right? Inflation, job market, things look generally okay. But what does worry me, though, is kind of socioeconomic phenomenon or attitudes and politics, just the vitriol and the division that I see in our country. That makes me worried from a big picture standpoint, and just some random, church attendance is down. I know that's probably the same for me. I used to go to church all the time. Since the pandemic, I've fallen out of it. But this is a longer term deal, 20 years, we were at 70% church attendance 20 years ago, now only 47%. But trust in the government to handle problems. Longer term trend, slow deterioration, in 2013, local maxima here, but declining. Only 39% of people think the government can handle our problems. American personal happiness, you know, generally seem to be pretty happy. Normally you'd say 86%, that's pretty good, right? Well, you know, 10 years ago, we were at 4% of people were very unhappy. Today, 14% are very unhappy. So that's a sizable jump. Okay, so this is an example of me wondering, well, why don't people trust government? You know, what's the core of this problem? I don't have an answer. This is a total anecdote, but just as an example, like this is from back in February. The poll of the American people, this is, should we send our kids back to school during the pandemic, K through 12? Back in February, so the pandemic's still going pretty strong. 79% of the US people thought we should be sending our kids back to school. But did we send our kids back to school? At least in Illinois, and no, we did not. So oftentimes, this is just one anecdote, but oftentimes what the people are telling the government they want is not what the government is doing. So maybe that's why some of this distrust and confidence in the government. How about this one? Trust in the American people. Do you have trust in the American people is the question. You know, back in 2005, yeah, everybody, yeah, we're great, we can do it. Today, you know, still above 50%. I guess that's a minor win, but quite a deterioration. Trust in our institutions. What percent of the American population trusts our institutions? And it breaks it out by race, but that's not really the picture because all the races are pretty much in the same ballpark, more or less. So the only institutions that Americans believe in, small business, military, the police, just barely 51%, okay? Now, all the other institutions, we don't have any confidence. You know, Congress, 12%, television news, 16%, big business, 18%, newspapers, 21%, public schools, 32%, so on. So, you know, we're kind of distrustful people, I guess. And then this is random, marriage trends, the thing that the Bureau of Census just came out with this. This is 2016 data. They literally just came out with this a couple of months ago. So sorry, the data is a little bit dated, but you know, here we see between 2006 and 16, this is men, if you look right here. So men up to the age of 54 in this category of 45 to 54, 17% of men never been married. And as these younger folks graduate into these higher categories, I mean, I guarantee this is going to shoot up as time goes on. So I guess my observation, it seems like, you know, we've lost some confidence even in the institution of marriage, which would be a trend that Europe has gone through. Okay. Any questions, comments on the macro side of things? Anything? Observations? Nobody? All right. So generally speaking, I'm going to give a super high level view on the agricultural markets. And the reason I'm going to do such a high level is because we have on the agenda, we got some real high-powered experts that know more about it than I do. So you'll get that later on. But generally speaking, ag markets this year have been quite strong across the board and driven, I would say, primarily by three reasons. One is we had this massive drought in the US. This is the drought monitor. So exceptional date drought, which is, you know, I forget the exact definition, but this is like 1 in 100 years. These are massive droughts here. And this was after we got a lot of rain, very, very late, too late in the season really to do any good for the crops. But it was either this drought monitor looked much worse earlier in the year. So we had the drought. Brazil, our major competitor on the soybean and corn export situation, they also had a severe drought as well. And former Soviet countries, Kazakhstan, and who's our buddy up here? Canada, they had a drought too. So, you know, all these major grain exporting countries in the Northern Hemisphere, mostly with the exception of Brazil, had droughts, so caused a shortage in grain generally, which led to high commodity prices. And, you know, this is more so at the grocery store level and restaurant level, but there was some massive, major changes in how Americans spent their food dollars. So you see, and we were just in the summer, we were just getting kind of back to the long-term trend of Americans spending more or less the same amount at home versus away. And now this is before Delta, and this is going to crash again from Delta. But that was a real dynamic for our food manufacturing companies and the ability, especially those that funneled primarily into the food service segment, caused major heartburn for those companies. Exports, touched a little bit about our export competition, but our primary grain market at the moment is China. And we saw a resurgence the past past year and a half, we saw a resurgence in grain exports to China in coordination with our phase one China deal from a few years ago. And by and large, this looks like a great success for agriculture, because we got almost back to where we were before we got tough on trade, or I guess we're slightly better than we were. But you know, the trend, if you go back, the trend had always been increasing, and then some rocky times and so on. But if you look at the other goods that fit under the phase one trade agreement, agriculture has done really well, but manufactured goods and energy that were also part of the agreement are not doing nearly as well. Manufactured goods only at 61%, energy 42%. So a lot of people don't realize this thing expires at the end of the year, so we don't know what follows phase one. And the Biden administration has essentially more or less followed the Trump administration's get tough on China policy. So it's going to be interesting to see what happens. And we go back to this ag exports to China. This can't be presumed to be the new normal. We could go back to here, or we could go up to here. You know, with China, you never really know what's going on. For those of you who haven't been living under a rock for the past year or so, corn prices early this spring, due to the reason the droughts, the world droughts, the trade situation, the coming back of demand for commodities, hit over $6. I can't remember what did cash hit here? What was the high? Nobody knows. Okay. So it's eased off. The drought, if you look back at the map, most of our corn growing regions kind of luckily escaped the drought, at least as dry as happened in Illinois, that our crops did pretty well. So wheat is the only one that really got hammered up in the Great Plains and the Dakotas and Minnesota. So wheat, the chart would look similar to this, only go higher, and it stayed higher. Cattle, I was all excited, man. We were on this run here, and you know, the past month or so, things have gone south. I'm sure Darryl will talk more about this afternoon. I believe that the reason is because the slaughter facilities have had such problems with labor that they cannot run the plants at full capacity. So now we have a backlog of live cattle that can't get slaughtered. And in that scenario, obviously the price is going to collapse. Longer term trends on wheat and corn and soybean production. You see generally we've been growing less and less wheat, more and more corn and beans. And we'll probably see a little jump next year due to the extremely high price of wheat this year. And the other thing is you'll see over time, we're going to see more and more soybeans and less corn, although the combination will still be quite high. And what's going to cause that is, here's a chart, overlapping chart. We have two different axes here, but soybean oil in blue, soybean meal in green. And for the longest time, going back 20, 30 years, you know, I always, in my opinion, the market was driven by the meal side of things, which goes into animal feed, you know, hogs, poultry, dairy, what have you. And soybean oil went into potato chips and French fries, right, and exported to other countries. So, but that's really changing. And soybean oil, I remember when it used to trade for about 15, 20 cents. Now, you know, kind of last few years it was at 30 cents, and it's been trading up at 60 cents. So what's going on here with the oil price? And what's going on is the oil is being converted into biodiesel. So you go way back to 2005, I think, with the Renewable Fuel Standards Act. It was mandated that by 2020, 2025, something I don't know the exact date, that there would be a certain amount of non-corn-based ethanol or alternative fuel used and biodiesel used. Well, that didn't really come to fruition. There was a great hope of cellulosic ethanol made of wheat stalks or prairie grasses or what have you, algae, and none of that really has come to fruition. And now we have every corporation in America seemingly saying they are pledged to be carbon neutral by such and such a date. So really, if you're going to get rid of diesel, the only viable, you know, alternative at the moment is biodiesel. So if existing capacity is roughly 35,000 barrels a day today, whatever, 40,000 barrels, you know, we're going nearly in the next few years, proposed or announced, could be up to 10 times that amount of biodiesel production. You know, probably won't be 10 times, but it's definitely going to be 7 or 8 times. So again, I have a pencil out, an economist on my team that is working on it right this very subject at the moment. You know, how much soybeans are we talking about here that are going to be going into biodiesel? Obviously, we're going to have a shift away from corn into beans to generate that much soy oil. Ethanol, you know, the industry's doing okay. You know, margins at the moment are quite strong. I think a year ago, people would have been tremendously happy to have the margins that have turned out this year. So despite the huge spike here, or what's it invert spike, collapse of of ethanol demand and production during the early on stage of the pandemic, the industry has more or less recovered. Vehicle miles. Now, what you don't see is this long-term trend is slowly increasing. So, you know, the pandemic did take a bite out of vehicle miles traveled. We'd be a little bit higher had it not been for the pandemic. Again, switching, my slides got a little bit out of order here. So at times we're not in the most coherent path, but livestock trends, if you go back 5-7 years and you look out for the next 2-3 years, I got here cattle, hogs, and poultry. And what you see on average is cattle and hog production has been trending downward and will continue to trend downward for the next couple of years due to generally poor profitability in those segments in past years and high feed costs. And so on. So, you know, the cattle cycle in particular takes several years to change course. So, and even at the farmer level, cattle returns are not great. So, what that tells me is meat prices are going to be sky high for the next few years at a minimum. And those segments should be on pretty sound footing. Consumer demand for meat, Kansas State does a lot of demand estimation, and according to them, red meat demand is at record highs at the moment. So that, meaning the consumer preference for red meat is record high. And anecdotally, if you look at what dietitians and so on, or Instagram people, I think protein is quite the story nowadays. So would expect that to continue. Interestingly enough, the poultry segment has been flat, particularly the past couple of years. They switched over to a different genetic line. It's a very inbred industry, and most of the industry uses one genetic type of bird. So they switched to a slightly different bird, and that bird doesn't have the same livability characteristics. When you put an egg in and hatches, and you put it, you try to bring it into the grow out facility. Through that transition, the mortality rate is a little bit higher. So that industry has been struggling with that topic a little bit. Going back to hogs here, this just shows that it's kind of complicated, but we won't get until mid to late 2022 before we start to turn upward in the supply of hogs. So obviously prices are going to be high, and people say, well, why are hog farmers so slow to respond to they've had record profitability this year. And I think ultimately they've been burned so many times before in the recent past that nobody's in a big hurry to get burnt again. So they've been very cautious about ramping up their supply. And there's probably also some uncertainty with Prop 12 in California, which is the law in California, which is going to take effect sooner or later, I think the beginning of next year, that says any pig and pork in California that's sold in California must be raised under these certain guidelines of space per sow and so on and so forth. And I think it's only about 35% of our pork supply already meets those California definitions. And for years, the pork industry has been suing in federal court and so on. And going with that, but the courts have agreed with California that they're free to do that. So now it's getting to be crunch time, and we'll figure out here within the next year how this all plays out. And California
may not have enough bacon to go around. You know, and they're a huge market, right? So that could have an impact on our hog prices if all of a sudden we can't ship our pork to California, and we have to divert it to export markets or make you guys eat more gravy and biscuits, but we'll see how it goes. Dairy, as far as I know, Oklahoma's not a big dairy state, but wanted to touch on it. There's been a big shift in industry toward states like Oklahoma. So in Texas, Kansas, some big dairy operations moving in and growing in those states due to lack of or more favorable attitudes toward livestock production and generally wide open spaces, reasonable feed costs. Remember I told you that almost every segment of agriculture is doing great, reasonably well. Not dairy. Dairy, I was a dairy farmer, I may have mentioned, and I've studied this market for 25 years. I've given up hope. Like I've been Mr. Hopeful for decades. Yeah, dairy, we're the most, United States is the most efficient producer, and we can hit global markets, but man, they just get beat down every time somebody gets optimistic about the dairy industry. They get a beat down. But next year, so this chart shows profitability by decile. So this is margin over feed cost. So essentially, you know, operating margin proxy. So we've been in this year, we've been in the 10th or lower profitability range. And this big spike here, well, that was a result of, there was a food box program as part of the pandemic recovery thing. So the food box program bought up like all the cheese in the United States. So that shot up milk prices. So that was a one-off type situation. So that's not going to happen again. So anyway, these poor guys get ground down. Cotton. Any cotton people here interested? I mean, yay, we're finally back to where we were in 2000. This is global demand, global usage of cotton. And, you know, cotton markets were riding high 2005, 6, 7, along with the global economy was on fire. And we don't need to get into it now, but the cotton market had some serious unusual market circumstances, followed by the Great Recession, followed by, you know, it got to be much cheaper to produce polyester and synthetics and fashion trends. Cotton kind of fell out of fashion. Everybody was wearing yoga clothes, and it's just when cotton starts to get back, and we hit the pandemic, global pandemic, boom, back down again. But finally, maybe cotton is back on its footing and will continue to grow. I mean, it's a really great fiber. If you get into, I'm a cotton nerd, you know, if you get into science, man, you can do all kind of great things with cotton. And here's what cotton prices have done. This is a pandemic low. They quickly rebounded. 60-cent cotton, you know, that's not horrific. It's not great, but it's doable. But so since the beginning of this year, we've gone from 70. This chart's out of date. Went up to, I think, $1.13. So we went from 70 to $1.13. We've dropped a few cents. I remember $1.06 or something now. But cotton markets are a big success story at the moment. USDA, this is a couple weeks old, came out with their farm income forecast for 2021. So overall U.S. farm economy, everything, soup to nuts, whatever is all in here. And we see net farm income. I like to use the blue one here. Net farm income, the average is about 95 billion, and we're going to be up at 113 billion in 2021. So doing pretty good, the highest level since I think 2013, 9 years. So I think next year will be, I'll wait. This next chart shows the breakdown of costs at the farm level. So we see trend, this gives you 3 years of trend for fuel, feed, labor, and so on and so forth. Nothing too out of the ordinary. Generally, this year we've had some inflationary costs, but next year, 2022, some of these costs are going to be astronomical. Like fertilizer, that's going to shoot way up. At the moment, fertilizer prices are about double, and that's closely tied into, well, supply chain, but more importantly, natural gas prices, which we talked about are already double and could get worse. Chemicals, a lot of them come out of China, supply chains, talk about energy problems there, so on. So crop supply is going to be an interesting market, and farmers aren't going to often get their first choice of the type of chemicals that they're going to be using. So I just wanted to say, I think generally things look optimistic for 2022. Maybe profitability will come down a hair, but it still should be fairly strong given commodity markets and the expectation that there's no way we can rebuild supplies to where they need to be in the course of a year, maybe 2 years. So should be fairly smooth sailing, with the exception of isolated industries like crop supply, will also have a lot of volatility and price risk management issues that they have to look at. Volume sold might be down, lower if there's no fertilizer, you can't sell fertilizer. And this is a farmer opinion as to their situation. Anything above 100 is mildly optimistic. So although we've come down from sky high earlier this year, as this is like the corn chart. If you look at corn prices and overlay it to the farmer attitude, I'll bet it's probably pretty close. So we saw corn prices come down a little bit, so slightly less optimistic. But anyway, that's about all I have. Anybody have questions, comments, arguments? Yeah.
On the containers that are in California, is it unloading that's the problem? Is it getting them out of California that's the problem?
Yeah.
What's the
So as far as I understand, the problem with containers in California is it's multifold. There aren't enough trucks to move this stuff out. There's not enough space at the dock to even put the containers down on the ground. And there's not enough workers and so forth to actually unload the ships. So it's kind of a multifold problem. And I think if you study supply chains at all, which I've done like this much of, you'll see like these little hiccups just cause massive problems, like a crash on the highway, like one little crash and you got a 10-mile backup. And what is exacerbated this problem is the holiday season. Everybody's been terrified of not getting their goods for the holiday season. So everybody ordered early, everybody ordered a lot. So at the moment, I think we're at the peak problem, peak overload of the docks and shipping, and it should clear up within the next couple of months. But what I mean clear up is we won't have 90 ships waiting to unload. Maybe we'll have 20, 30. So it should get better at the turn of the year, but the supply chain woes, that's going to continue for at least 2022, if not further, in my opinion.
some of the trucking companies I've talked to said it's California's 2010 new truck rule that they can't keep.
There's I've heard that anecdotally too. The problem that certain trucks are not allowed into the state of California because they don't have the proper emissions equipment and so on. And so, yeah, I have heard that. Yeah. Well, I think they'll pretty much just trend interest rates. So they'll should be fairly steady as she goes, mild increases as we go. I think there's a lot of demand across the world and across various financial actors, you know, to have a little fight of land and portfolios through one mechanism or another. So you know, I don't know if I would invest in land just because there may be better investments, but I certainly don't see it going down anytime soon.
Just doing a lot of trends, going back to trend line. Do you see any place where the new normal is not going to be where the old normal was?
That's a good question. I think what's occupied my mind is how long. Oh, yeah, sorry. Trend lines of any sort that we will not eventually get back to the trend line. So permanent alteration either in a lower trend or a changing of the slope of the trend line. And my mind has been wrapped around how long. I'm of the opinion that a lot of these trends are going to take a lot longer to get back to than most economists think. Primarily in the labor market, it's going to take years, I think, to get us back to the levels of employment that we had. So that's a headwind on the economy when you have unproductive people. Let me think about that. You got any ideas? Yeah, I mean, you haven't.
It seems like labor may be just totally different.
Yeah. Yeah. So they never get back to where it was. Questions, comments, opinions? Let me ask you a question. Kind of those non-economic, those attitudinal, sociological phenomena that I help with, essentially boils down to distrust in our institutions as an American society. Raise your hand if that worries you at all. What's the definition? Yeah, well, that comes with California. But yeah, it's on the Gallup website. I believe they tend to be true. Maybe, hopefully, I'm wrong, but just kind of this distrust of all of our American institutions gets me worried about big picture, longer term things. I don't know how it'll play out, but I guess as a businessman, I'd be thinking, well, what does this mean for my business? Sure I didn't miss anything. Also, just briefly, as it pertains to the rural economy in particular, we've got generally the macro indicators generally positive, as we talked about. The ag sector is doing well, should continue to do well. Energy segment, prices are the highest they've been in 5, 6, 7 years. Energy segment should be doing well. I think anecdotally, there's going to be less focus on people having to work in cities and urban places, freedom to choose where you want to work. So that could be a tailwind for rural economies. The infrastructure package should provide quite a bit of funding for improved broadband service to rural America. So, in summary, I think things are looking generally positive for the, specifically the rural economy. So, all right. With that, I will turn over the mic. Yeah.